Thanks, everyone, for joining us today. Our next speaker here is Ron Vejrostek. Ron is with Financially Intact, Vejrostek Tax and Financial. He is going to be talking today about understanding annuities, scams, or safe investing. And he is the author of the book Financially Intact, Making Money is Easy, Keeping It is the Hard Part. Ron offers consultations on a wide range of financial topics, and today we'll on the subject of annuities. And just a reminder, often at these talks, we do run out of time at the end for Q&As, and all of our speakers today will have a booth, and Ron included, will have a booth in the Expo area, so you can always have, if you have any specific follow-up questions for Ron, you will be able to find him right down the hall. All right, Ron, all you.
Super, thank you. So, good morning. I am the author of Financially Intact, Making Money is Easy, Keeping It is the Hard Part. So we're going to talk about annuities this morning. Of course, that's a financial product. And so I want to cover and make sure that we're actually clear on a couple other financial concepts first, because it'll help make sense of all of it here at the end. So the couple of concepts we want to cover, and this is the first one, is that when it comes to finances, well, anything in life, really, there is no free lunch. Everybody agree with that? In order to get something, you have to give something up, right? Well, when it comes to finances, there are three moving parts, only three moving parts, and always three moving parts. And they are risk, reward, and time. So in order to get more of one of those, you have to give up some of one of the others. The brief, quick explanation of that would be like a 1 year and a 5 year CD, right? So the risk is the same because they're all FDIC insured. So you're safe. But so what do we have left? We have reward and we have time left. So if you give them more time, a 5 year CD versus a 1 year CD, you're going to make more money, right? They'll pay you more. So that's the way finances always work. So then the next part that we want to, other concepts we want to cover real quickly here before we get to the actual annuity part, is if you'll turn to page 2. And it's the one with all the real small print on it. So this is the record of the S&P 500 over the last 71 years. I don't like it when people pick 5 years or 10 years and try and show you and tell you this is the way it's always going to work. I wanted a whole lot of years. You can get these numbers yourself by going to historical quotes on Yahoo Finance for the SPX. So what it shows you the year, then shows you where the S&P 500 started for the year, where it ended for the year. Then the next two columns is how much did the S&P 500 make or lose, both dollars-wise and percentage-wise. After that, it looks like it gets real boring, right? There's two columns with a whole bunch of ones in them. So you think, well, that's not much, but yet these are the two of the most important columns. Because what they're doing is they're counting for us how many winning years did we have in the last 71 years in the S&P 500, and how many losing years did we have over the last 71 years. As you can see, it's 53 winning years and 18 years where it went down. So for winning, that means it went up 74.64% of the time. Is everybody okay if I just say it's been 75% of the time instead? So the market's up, 75% of the time. It's down for 25% of the time. Your average up, the next two columns will show you that at the bottom. It's going to show you your average up is 16.6%. How many would have guessed that it's that high on average up here? And your bottom is, or your down years are 12.6%. But we have to remember, this doesn't, just because I said 75% of the time, which it is, that doesn't mean it's up for 3 and down for 1 and up for 3 and down for 1. You get the idea. It doesn't work that way. 75% of the time. So that means we know up markets will last 3 years, 5 years, 7 years, and now it's just proven out to be that it can last as much as 10 years. But the opposite is also true. The down years do not last 1 year. The average down market will be 18 to 36 months, and that's just on the way down, and then it takes a while for it to come back up, right? So your downs can be, 24, 36, 40%. So this is where it gets important, is that we need to have money in the market because we've proven, or it's proven itself, that the market always comes back and it does quite well. And so we need to have money in the market because that's where most of our money is made. The problem is we don't want to be taking money out of the market when the market is down, right? So we need a place where we have other money so that when When the market is down, we can pull money from here. When the market is up, we pull money from here. Whether that be required minimum distributions or just because you want to take it out to maintain your lifestyle, or you have to take it out because a tree fell on the car, or whatever the case may be, we have to be balanced so that we have money somewhere else besides the market so that we can pull our income from there and giving the market time to come back up. So now that we've covered those two topics, let's get on to what you came to learn about. So annuities, there are basically 4 types of annuities. There's immediate annuity, there's fixed annuities, there's fixed indexed annuities, and then there's the variable annuities. The top 3 are guaranteed not to lose money. The bottom one, the variable annuities, are not. They do not have that guarantee. Some of them say they do, but you got to read that print real carefully as to how they make that guarantee work. We'll get to part of that here in a second. So let's cover each of these. Immediate annuity. So an immediate annuity means you give the insurance company the money now, and 1 month from now they start giving you a monthly income, and that's going to last as long as you live. This is how most pensions have been built over the years. You worked for a company, at the end the company gave the money to an insurance company, the insurance company purchased an immediate annuity, and then you had your monthly income for as long as you lived. Now, some people worry about this. They go, well, what if I only live 2 months and then die? The insurance company gets to keep all my money, right? Wrong, because most of these you can guarantee that somebody's going to get those payments for at least 10 years or at least 20 years. But remember, at the beginning, we said to get something, you have to give up something, right? So if you're going to make sure that somebody's going to get those payments for 10 years or 20 years, you're obviously going to get a little bit less on the monthly income because they have to make this work for you. So like I said, it always comes back around to get something, you have to give up something. So that's how the immediates work. I know I could go much deeper into each of these, but we only got like 20 some minutes, and so moving on. Fixed annuities. Now fixed annuities, they work just like CDs. There's going to be 2 minor differences. I'll talk about that here in a minute. On the average, they go 3-year to 10-year contracts, and that is one of the differences. So a CD, of course, you could buy a 6-month CD, you could buy a 9-month, a 12-month, and all that. The shortest fixed annuity that you could buy is 3 years. They don't have like a 1 or a 2-year. The most popular are the 3 and 5-year, and they are just like a CD is. And at the end of the 3 or 5 years, you take your money back out, or you renew it, or you can do whatever you want with it. But it's your money to do what you want with it again at that point in time. The other difference between annuities and CDs is that with an annuity, you can, in years 2 and beyond, so 2, 3, 4, 5, whatever, you can take out 10% of your money without breaking the annuity. Now in the CD, if you wanted to take 10% out, they're not going to let you do that. You'd have to break the CD. They'll let you take your interest sometimes, but not 10%, whereas the annuities will. Then the other thing is, here in Colorado at least, all money coming out of annuities is considered pension money. And so if you haven't used up your entire exclusion yet, money coming out of annuities is tax-free here in Colorado up until you've hit your pension exclusion amount. Current interest rates for 3-year contracts is around 1.45%, and for 5-year contracts, it's around 2% right now. Okay, so I'm going to jump to variable here just for a second because we're going to spend the most time on the fixed indexed. Variable annuities, of course, they are invested in the market. You're actually owning ETFs, mutual funds, the equivalent of those inside. So variable annuities, you can make quite a bit more. Problem is, they're not risk-free anymore, so you can also lose quite a bit. And then problem number 2 with variable annuities, as far as I'm concerned, is the high fees. There's usually mortality charges, and then there's management fees, and it'll run anywhere from about 2.5% to 4% fees. Some even go a little bit higher than that. I do not sell variable annuities, so I'm not going to go deeply into that discussion. I can have that discussion with people if they want to do it one-on-one at a future point in time. So let's talk about the fixed index annuities, because this is the one that is most misunderstood and yet one of the really neat tools that we can use out there. And so what a fixed indexed annuity does is it participates in the upside of the market, but not in the downside of the market. And there are no fees to this, and you're going to see why here in just a second. And they offer what's called a reasonable rate of return, and I'll prove that to you right here at the end. So the first time I heard that, I said, I don't get it. And I'm a numbers guy. I mean, I own a tax and financial accounting firm. So I looked at it and I go, how can they go up when the market goes up, but they don't go down when the market goes down? I don't get it. So I decided I was going to study it, and which I did. And I've actually met the person who invented the whole concept, Richard Cato. I've met him 3 times now in my life, and the guy's pure genius. And then once I understood, I go, oh, these things actually can do exactly what they say they're going to do. So how does a fixed indexed annuity work? Here's how it goes. So you take $100,000. Sorry, I'm going to use really big numbers because it's really easy on my brain to make to do it this way. So we take $100,000. We give it to an insurance company. The insurance company's going to take your $100,000. They're going to put it with all the other money they have, which is billions of dollars, and they go and they invest this. And the insurance companies are making approximately around that 4% range on all of their investments. Well, out of that 4%, they keep the first 1.5% for themselves. That's what they use to pay for their people, pay for their buildings, keep their stockholders happy. That's what they need, is 1.5%. So that leaves them with, what, about 2.5% that our money is actually making for us that they could pay us, but we want more than that, right? So here's how they do it. If they know they're making 2.5%, they know they only have to, and they guarantee you can't lose money. They guarantee you're going to get all your money back, okay? And you're going to get whatever extra they make over and above that. Well, these are run for, on the average, 5-year, 7-year, 10-year on indexed annuities. So I'm going to use a 10 because, once again, it's easy on my brain at the moment. So if they're going to invest the money at 2.5%, and at the end of 10 years, the absolute minimum they could give you is all your money back, they know they only have to invest $78,500 compounded at 2.5%, gives them the whole $100,000 to give you your money back at the end, okay? So what that did is it just freed up $21,500. What are they going to do with that $21,500? They are going to buy the options on the market. So they're not investing in the market. They're buying the options on the market, and this is how it's going to work. So we need to understand options a little bit. So what is an option? An option, when you buy an option, you are buying the right, but not the obligation, to buy a particular item at a set time at a set price. One more time, you are buying the right, but not the obligation, to buy a particular item at a set time at a set price. Let's get away from the stock market here for a second. Let's pretend, let's do something that's more kind of everyday. Let's say you're retiring right now and you want to sell your house so that you can move closer to your kids and grandkids. Commendable idea. So you put your house up for sale. I come up to you and I go, wow, I really like your house. I like the neighborhood. I like the price. I like everything about it. And I've got enough cash that this is going to be a cash deal. It's going to be sweet. There's only one little glitch in my giddy up, and that's I'm not ready to buy this house and move to this neighborhood till a year from now when I retire. So what I'd like for you to do is let's put up a contract and say, I can buy your house from you 1 year from today at today's price. And you think about that and you go, well, you know, the markets keep going up. It's worth more now than it was a year ago. My house could be worth more next year, so I could be shooting myself in the foot. On the other hand, I've also heard that, you know, we're at the top of the market and someday this thing's going to come back down, and who knows, maybe next year my house is worth less. So you think about it, you finally say to me, you go, I'll tell you what, if you'll give me $5,000 right now and I get to keep the money, whether or not you come back and buy the house, then I'll make that deal with you. I say, okay. So I give you the $5,000. I come back a year from now. Your house is worth $15,000 more. I say to you, I gave you your $5,000 and now I'll give you the full price. I want to buy your house. You sell me the price. You sell me the house, right? But let's say I came back a year from now and your house is worth $15,000 less. Am I going to exercise that option? Or am I going to go across the street and buy the identical house for $15,000 less? I'm going to walk away from the $5,000, right? And just go buy this other house and save myself 10 grand, basically. And so what I had done is I bought the right, but not the obligation to buy the house. Okay, we're back to the insurance companies, the stock market. So the insurance company goes to the stock market and says, okay, we want to buy the S&P 500 index 1 year from today at today's price. Wall Street says, okay, That's $5,000. Insurance company goes, we don't have $5,000. We got the 21,500 divided by 10, 2150 a year. We have $2,150. Wall Street goes, okay, 2150, 5,000, that's about 42%. We'll give you 42% of the movement of the market for the 2150. Insurance company goes, okay, that's fair, we'll do that. And so that's what they do. A year goes by. Market's down 10%, 20%, 30%. Maybe it's going down 4%. Who cares? It's down. Is the insurance company going to exercise that option or walk away? Walk away, right? Are you okay? Am I okay? Is our money okay? Our money's over here. It's on there's a wall right here. Everything on that side of the wall is guaranteed. Everything on this side of the wall is market related. So our $78,500 is sitting over on the safe side of the wall, earning 2.5%, plus all our 2150s, the other 9 2150s, right? They're sitting on the other side of the wall, earning 2.5%. So they can walk away from that 2150, our money is still intact. Let's say the market went up instead, and the market went up 10%. We're getting 42% of that, right? So now we get 4.2% interest credited to our account. We get all of that because the insurance company doesn't need it, because remember, they kept the first 1.5% to pay their bills and make their profit. So that whole 4.2 goes onto the safe side of the wall, and now it's going to earn 2.5% also. This is why the indexed annuities make money when the market's going up, do not lose money when the market goes down. Got it? That's how they work. So, are they a scam, or are they a tool that should probably be considered for part of your portfolio? And like I said at the beginning, we have the market, and the market goes up and the market goes down. We don't want to sell out of the market when it is down. We want to buy time. These things will average about 3.5% to 4.5%, and I'm going to prove that to you if you go to the next page, second to the last page. So if you remember on the second page, it showed us that the stock market averages 6.6% on the up years, right? And it's up 75% of the time. So if we take our 6.6%, now indexed annuities are highly sensitive to interest rates. So your participation rate varies greatly. In the last 2 years, I've seen it be anywhere between 25% and 55% of the market, which is nice. So I'm going to use a lower average, which is about, are you looking for a booklet? We got one. Okay. So at about, we're going to use a 35% participation rate. So if you go 35% of 16.6, you end up with 5.81. We have 3 up years, 1 down year, right? 75% of the time. So 3 times 5.81 is 17.43. On the losing years, we don't put it in negative, we just put it in 0. So we have our 17.43 divided by 4. And as you can see, that averaged out at 4.35, which is not a bad return for something that's 100% safe. So with all that said, I do want to mention one other, the last page that you have in your booklets there. What I do is I teach people how not to lose money. That's what I do. I have a YouTube channel. There's 30 videos on there about different financial topics. And one of the things we've come across here lately that we want people to know is that a lot of you have Medicare Advantage programs, and one of the scary parts about that is that $300 copay if you're in the hospital for up to 5 days, and that can happen more than once a year. You can cover that $300, $325, whatever it is on your plan, for about $25 a month. So that takes the fear out of those maximum out-of-pockets. So with all that said, I did so well, not a single one of you has a question, right? Oh, I'm right, no hands went up yet. Oh, there we go. What's your question?
Would you address the part about no fees?
Yes. So there are, as I was saying, when the company's making their 4%, they take the first 1.5%, so there are no additional fees charged on fixed or fixed indexed annuities, or immediate for that matter. They do pay me, and that comes out of that 1.5% that they use of all of their monies. They make that 1.5. That pays their people, which is part of me. It pays their buildings. It pays everything. So there are no additional fees on these.
Would you compare corporate bonds with annuities?
Okay, so corporate bonds, so long as you hold them to maturity, they are safe. And that's what Wall Street will always try and tell you is bonds are safer than stocks. Who wants to hold on to a bond for 30 years or 15 years or 20 years a lot of times? So as interest rates are moving up and down, the value of your bonds goes up and down. Does everybody understand that, or do you want me to explain that real quickly of why that happens? Okay, so let's say you have a bond that's earning 2.5% right now. And next year that bond is earning new bonds are earning 3.5%. You want to sell your bond. Who's going to buy your bond when it's only paying 2.5% when they could go across the street and buy one for 3.5%, right? So what you have to do is you have to discount yours down so it's getting the equivalent of a 3.5%, and so you'd end up selling your bond at about 85% of what the face value was of what you bought it for. So that's why the value of bonds goes up and down as interest rates go up and down. So they're much longer term. They are safe if you'll hold them to maturity. The annuities are much more flexible, as in you still get your 10% withdrawals every year. You can't do that with a bond. They're much shorter term, 3, 5, or not 3, yeah, some, but 5, 7, 10 years on the indexed annuities. And then the other thing, beauty about an annuity, and some people use this, a lot of people don't, but the pensions again. You can turn any annuity into a lifetime income. It's the only product in the world that you could do this with. That's why they get tax-deferred status from the U.S. government. It's because of that little fact right there. So, great question. Thank you.
Well, thank you. I was understanding too that the bond, the maturity date would be 85 years out, 6 years out. We're not talking long term. And it's a guaranteed rate. Is that not right?
That is right.
Or 9% or 6%, whoever says it, October, December, depending on the So
Yes.
the maturity date, and it will not deviate from that. It will only be 10,000 and 4%.
Right. If you hold them to maturity, and there are some short-term bonds, they're not real common, because even intermediate bonds are considered at 7 years. 7 to 12, I think, is considered intermediate.
I'm not following
So-
that, I'm sorry.
You have short-term bonds, long-term bonds, intermediate bonds. Intermediate 7 to 12, I think, and short is something under 7.
Okay, thank you.
But they are hard to find and come by, but they are out there. As long as you hold them to maturity, they're safe. Yeah. Once again, though, here's the problem. Let's say half your money's in bonds, half of it's in index or in the stock market. The market's down, you want to pull money out of those bonds. You can't do it. You lose that flexibility.
You cannot withdraw.
Right.
Okay, got it.
Yeah. There's so many. What time we got? Your hand went up first, I know. Did you still have it? Okay, that one.
Is your income from an annuity taxable as income every year? Or is it part of your required minimum distribution?
If you're she asked if the income from an annuity is taxable. If it's an IRA, yes. If it's earnings come out of an annuity before principal does. It's one of those weird things with tax-deferred products. So until you get down to your principal, yes, it's 100% taxable. On the other hand, if it is an IRA and you're taking money out of an annuity, it does count towards your required minimum distributions.
Thank you.
One more? No?
Unfortunately, we're out of time.
Come by the
Our
booth.
next speaker starts in 2 minutes, and we got to give time to transfer over. Ron, thank you very much.